All right. Well, thank you very much for joining us this morning. My name is Frank Michike. I'm the Managing Director of the Next Social Contract Initiative here at New America. This is quite a group we've got together, so I wanted to make sure we got going relatively close to on time and had time to hear from everyone. I want to thank you all for coming. This is probably not for those of you in the room, but probably for the larger policy community and then those beyond. One of those under-examined topics that is hugely important to the fiscal future of the country, as well as social policy goals that the country has developed. The image that we've used to sort of represent this is the one up here, which compares the spending on the TARP program that certainly has been front and center and in the news, with the spending roughly on individual income tax expenditures every year. And they're about equivalent. And so what we're trying to say with that is that this is a big deal. This is a prominent issue, a huge amount of money that we're spending on these. And so if we're going to spend money this way, and if we're going to do social policy through tax expenditures, it should be well examined, well thought out, and the goals, equity, and social policy goals should be well thought out. So that's hopefully what you'll get from this morning's presentations and the discussion that follows. We're going to start off with a word from Bob Frank. Bob is a distinguished professor at Cornell of management and economics. He's also a columnist for the New York Times, his Economic Scene column. He's written a number of books on behavioral economics as well as income inequality and issues around that, all of which relates, of course, to the distribution and the process of using tax expenditures for making social policy. So we thought he would be a tremendous keynoter to start things off, and so I present Bob Frank.
Thank you very much. I got the invitation from Ray Boshara, and I tried to beg off. I told him I didn't really know anything about tax expenditures, and he said, "Well, you know, talk about what you know about. That's always good advice." And I feel very fortunate to have accepted the invitation because, in the process of thinking about what to say, I discovered I actually did know a little bit about tax expenditures. I didn't realize I knew that, but I also made some connections that hadn't occurred to me before. So I'll just try to share some outsiders' thoughts on the subject. That's not always useful, I understand. I'm going to try to figure out if I can get to my own slides from this one. It's supposed to be something I know how to do. Okay, here, just some general summary thoughts. If you think about a tax, it has two effects. It generates revenue. That's the effect people think about when they think about a tax. But it also has a second effect, which is to discourage the activity on which the tax is levied. People often don't focus on that second aspect of a tax. Look now at tax expenditures. There's a similar two-way partition. The tax expenditure reduces revenue, or equivalently, it increases the recipient's disposable income, but also encourages the activity. I think when we think about taxes, we think about the revenue that we get from taxes, and we don't think much about the activity that gets discouraged. When we think about tax expenditure, we think about the activities we're encouraging. We don't think much about the revenue we're losing in the process. This often leads to wrong-headed thinking. A dollar is a dollar. Thinking about dollars in one bucket as being fundamentally different from dollars in another bucket generally leads to bad conclusions. The fundamental principle I try to teach my students is that you should do it if the benefits exceed the costs. Otherwise, you shouldn't do it. It doesn't sound controversial, and it's not, but it's hard to get it right. If you think about different dollars being worth different amounts, you're almost certain not to get it right. Okay, I'll try to defend two simple points. I'll repeat them at the end. I have been doing a long-standing study of the introductory economics course, which it turns out leaves no impact at all on students. The tests that are given to students 6 months after they complete the course show that they don't answer questions about basic economic principles any better than students who never took the course at all. It's an astonishingly dismal performance. And I think it's because people throw too much stuff at their students and off of it in much too technical a form. So if we would slow down and repeat and try to figure out what's important, people would walk away with something useful more often than they do from our courses. So these are the two ideas I hope people will walk away from today. Don't tax useful things. Our current tax system taxes lots of activities, job creation, savings, and a whole lot of other things that are incredibly useful. We discourage those things. It's not our intent, but we do it. Tax expenditures, we should use those only for activities that we want to encourage, but there's also a second dimension to the tax expenditure. It's often a handy way to achieve targeted redistribution, and why you would want to do that is something I'll get to. Okay, savings is one of the issues I'll take up. Here's where I discovered that I'd been writing about tax expenditures all along, hadn't without even knowing it. I'm going to propose a major expansion in the current tax expenditure program that we have. And it's going to be an expansion designed to stimulate savings. Savings, lack thereof, is a harmful activity. We shouldn't be taxing savings. And so if we would encourage savings, and I'll explain what I mean about how to go about that with tax expenditures, that would be the proper use of a tax expenditure policy. Right now, our tax expenditures often push in exactly the opposite direction. So when somebody's deciding how big a house shall I build, the exemption for home mortgages, even on houses that cost a lot of money, for multiple houses that people own and so on, encourage people to own more house than would be chosen under the strict cost-benefit test. It's not a good use of resources. It's an exactly contrary use. Here's the most important idea I try to get across to students in my course. It's that efficiency should be your first concern. If you're not doing it efficiently, you're missing a chance to make everybody better off. Here's the theorem. The mathematical economists get angry at me when I call it a theorem, but the theorem is when the pie gets bigger, everyone can have a bigger slice than before. And the way you prove it is you draw the second pie with a bigger radius and you keep the slices at the same angle as before, and then it's one step to observe that each slice that you dole out has a bigger area than the slice in the old smaller pie. If you're not being efficient, you're missing a chance to help whoever your constituents are. If you're a politician and you're not proposing an efficient policy, that means you thought you couldn't figure out rhetoric that would convince people to sign on a deal where each and every one of them would get better off. Think about that. How bad of a politician would you have to be if you couldn't sell a deal where everybody gets a bigger slice than before? And yet, such is the nature of politics that we don't do those deals often. So I'll rush quickly through a couple of simple examples. Should there be free directory assistance? This question was posed by the New York State Public Service Commission back in the 70s. These things cost money to provide. The answer is obviously no. If you think about the cost-benefit principle, we should charge for them. And so the New York State Public Service Commission proposed a 10-cent charge. That would enable the phone companies to cut back on their expenses on this service. People could look numbers up on their own without much trouble, and we could spend the money more fruitfully in other ways. Well, there was a firestorm of protest. Sociologists testified before the public service community that this proposal would disrupt vital networks of communication in the community, personal relationships would crumble, etc. So it was clear that the proposal was going down the drain, and so my former dean, one of my early intellectual heroes, Alfred Kahn, said, okay, it looks like you got us, and he proposed a simple quasi-tax expenditure response to the objections. He said, here's what we're going to do. We're going to take your monthly bill, and it's going to be the same as before except for two things. You're going to get a 30-cent credit on your bill. We're just going to give you some money. And then we're going to charge you 10 cents for each call you make. So if you're poor, you're okay. Just look up the number and you're 30 cents richer than before. Note the trivial sums at stake here. The opposition vanished overnight to the proposal, and it was adopted. There's a message here. In a democracy, the interests of the poor are going to get some attention. Maybe in the room here, there are many who think they don't get enough attention. I think that. But they're going to get some attention, and if we don't attend to them in an efficient way, we'll end up attending to them in an inefficient way, and that makes both the poor worse off and the rich worse off. Abba Lerner, one of my first graduate school professors, said the main problem confronting the poor is they don't have enough money. Everybody laughed, but he was dead serious. He said the solution is to give them more money and figure out a way to do that. Tax expenditures, it turns out, are a very handy way to do that in some circumstances. Maybe not the only way or the best way in all circumstances. People object that redistribution is illegitimate. It's your money, you know how to spend it better than a bureaucrat. You don't want the bureaucrats giving it away to other people, especially, is a very effective rhetorical line that we've heard in recent decades. But think about the practical consequences of enforcing that kind of a policy. I'm going to use the LA smog example. 80% of the smog in LA comes from old cars that do not have to comply with the emission controls laws in California. Why are those cars exempt? Because mostly poor people drive them, and it was felt an unreasonable burden on the poor to force them to adopt costly emission controls on their cars. So how do we meet the air quality targets? We've got two choices. You can require all cars to comply. We rejected that one. Or exempt older vehicles and crank up the standards on new cars. Well, the new car standards, we've already picked the low-hanging fruit there. Any new pollution we remove from the tailpipe is very costly per unit. And so the overall cost of meeting the air quality target by exempting older vehicles ends up being vastly higher than the cost of a program would be to make all cars comply and give a refundable tax credit to poor people to buy a late model Honda Civic that meets the air quality standards. So if you say it's illegitimate to transfer to the poor in that way, then effectively, okay, they're going to pass a law saying the old cars are exempt, and that just means that the poor end up poorer, the rich end up poorer. Doesn't seem like a good solution when the option was there to make the pie bigger and give everyone a larger slice. Congestion fees, the same idea. London adopted them, and they worked. So the congestion is vastly lower in downtown London than it used to be. Smog is lower. The buses run a lot more rapidly on the bus lines. It's a program that worked. Mayor Bloomberg proposed this same thing for New York, and Louis Fidler, New York City councilman, called the plan outrageous because they're saying rich people can come into Manhattan and poor people may not. And that's just wrong, wrong, wrong. That's the direct quote. Well, a simple tax expenditure could have gotten us over that objection. Poor people who work in Manhattan, of which there aren't a huge number, could have been given a limited number of congestion fee vouchers that they could then transfer to others who valued them more highly, or on the rare occasions when they had to drive into the city, use them to pay the congestion tax. Why don't we do the efficient thing? It's a very interesting question, one that I've been thinking about for a long time, and I posed it to an economist statistician at a Canadian conference, and he told me a very, very interesting example. He said the Canadian trucking company had a right that had been granted by the Canadian government that was worth $5 million a year to the trucking industry. It was the whole industry that had this right, but it was costing Canada something like $100 million a year. Well, let's take that right back. So the Canadian government proposed, we'll give you $10 million a year if you'll surrender this right that you have. And they said no. The government went back to the drawing board and then decided, well, that's outrageous. We're just going to seize the right, eminent domain, reclaim it, and give them the $10 million payment that they wouldn't accept voluntarily. And that's what they did. And then 2 years into that program, public outrage over the $2 million payment resulted in it being rescinded. And so the trucking industry seemed to have its eye on the ball there. They knew they could get away with keeping the right because that was complicated, buried in the code somewhere. But a check going to us every year for $10 million, that's going to attract notice, and we're not going to be able to keep that. So I think it's many of the same problems explain inefficient tax expenditures. They're kind of buried in the complexities of the tax code. By the time you take the 30 minutes that's required to explain it to people, you end up not having an audience. Basically, you can't run a campaign that way, so the things last on the books. The minimum wage versus the earned income tax credit. Another example. Here's one where we should expand the tax expenditure. It's a very efficient way to alleviate poverty, much more efficient than the minimum wage, but you need to put money on the government budget to do it, whereas if you do the minimum wage as your anti-poverty measure, the money that it costs to do that shows up in the prices of goods people buy. It's not on the government budget. Is a big government bad compared to paying more for goods you buy? I can't think why it is, and yet that seems to be the bias that leads to that. You can't do it all with tax expenditures. We're going to need to raise new revenue. The investment program that's been proposed for the future with health insurance, high-speed rail, green energy and the like is going to cost way more than the current tax system can generate. And so we're going to have to figure out how to raise money to pay for investments. Many people are saying, stop making these investments. They want, John Boehner says we should go over the federal budget with a fine-tooth comb and just tear stuff out of it page by page. That seems wrong-headed if we're spending money on productive public sector investments. Let me just give one example. On the Northeast Rail Corridor, you can't get double-decker containers through because of a couple of low, the Harbor Tunnel in Baltimore and a couple of other low overpasses. You can't get these containers through, so they go up I-95. I-95 is clogged morning till night with these containers being trucked up. Now I-81's clogged morning to night because truckers are diverting 200 miles west because I-95 is so crowded. What if the only way we could do this investment was with borrowed money? I just read a study. It would cost about $6 billion to relieve the bottlenecks, and the benefit of relieving the bottlenecks would be $12 billion, not counting the reductions in greenhouse gases and other indirect effects. Just the congestion and fuel savings would be $12 billion. So David Broder writes a column, we're going to impoverish our grandchildren, hand them a bundle of debt. They're going to be poor forever because of this. If you don't do that investment because you couldn't figure out where to raise taxes, they're going to be even poorer by $6 billion. Making an investment that exceeds the cost of the money you have to borrow to make the investment makes you richer, not poorer. That's simple arithmetic. If you borrow money to do consumption, as we did in recent years, that does make us poorer in the long run. But if you borrow money to do investment, that makes us richer in the long run if the investments are well chosen. Public waste and private waste. People would be much better off in the long run if we could figure out how to pay for our own investments rather than borrowing money to do them. And the traditional place people look is in the public sector. There are these vivid examples of waste. So the Pentagon had a $640 toilet seat. It's your money, you know how to spend it better than any bureaucrat, sort of conjures up the image of the bureaucrat who's careless and willing to spend $640 on a toilet seat. Of course he's going to waste your money. Turns out that toilet seat was a space shuttle toilet seat in the account I tracked down, so it was actually costly to produce, but let's grant that sometimes government buys something that's not quite at the frontier price point. Private citizens don't often do that. They shop carefully and get their value. But that doesn't mean that there's no waste in the private sector. My claim is that contrary to the conventional view, there's vastly more waste in the private sector than in the public sector. And not only that, it's easier to ferret out. It's very difficult to get waste out of the public sector. Every president's tried, and they end up cutting good programs first as often as not. So the problem in the private sector is not that people are paying more than the cost of producing the goods they buy, it's that the goods they feel they have to buy are wasteful from a collective vantage point. Let me just give you a simple example. David H. Brooks, not the New York Times columnist, but a CEO of an armor manufacturing company, wanted to put on a special occasion for his daughter 3 years ago. And so he spent $10 million. He rented the Rainbow Room atop Rockefeller Center. He hired Aerosmith and 50 Cent, and all her 300 closest friends got a video iPod, party favor, and so on. That's what it takes in some circles to produce a special occasion. He wasn't necessarily a bad person. I don't know him. Maybe he was a bad person, but the mere fact of wanting to put on a special occasion for somebody you love is a totally normal human motive. I've got my 25th anniversary coming up. I'm going to want to get a special gift for my wife. What's that mean exactly, a special gift? Context defines special, and it's always and everywhere a function of what others are spending, what's expected to mark a special occasion. And it trickles down. So when he spends more on a party, it's certainly not his intent to harm me or others like me. I don't really care if he spends that much on a party directly, but I noticed when I'm walking to my office that there's a clown going into one of the NYU apartment buildings. Now it's expected that when a middle-class 10-year-old has a birthday party, there'll be professional entertainment. So it cascades down. The standards are set at the top. They cascade down. Nowhere more so than with housing, where the big houses at the top influence the people just below the top. Maybe now it's the custom to have your daughter's wedding reception in the home rather than the hotel. So they build bigger, and then people below there. So now the median new house is about 50% larger than it was 30 years ago. If you don't buy the median size house for your area, your kids go to worse than average schools. That's the rub. You may not want a big house, but if you don't buy one, if you don't keep pace with what your neighbors are spending, your kids go to the schools with the metal detectors, not other people. This is not controversial, what I'm saying. I think the economics profession will look back in deep embarrassment years from now and struggle to explain why for so long we insisted that it was absolute consumption only that mattered for well-being. Clearly, context matters. There's no dispute about this among anyone who's looked at the relevant evidence. And you see examples of how when spending at the top escalates, it puts pressure on people further below to spend more. This is my gas grill on the left. I went to replace it when it broke down, and I was surprised to see this model on the right. I won't take the time to describe all the features it has, but it was an extraordinary machine, $5,000. I said, no, I don't want to spend that much. And so he showed me the value model. Only had one ancillary range-top burner, and it was available at a value price of $1,160. I didn't buy it either, but if I'd bought it, I could have thought to myself, wow, I was a prudent shopper. I didn't fall for the chump model with all the bells and whistles. That's where the money has been going in the American economy. It's been going to the top. That's where the income gains have been going. And people at the top have been spending it, and that's shifted spending patterns throughout the rest of the income distribution. Now people send me examples of the latest grills. I wrote about this 10 years ago, and they just keep getting bigger and better. It's in every sector. So Victoria's Secret has a bejeweled bra in its Christmas catalog every year. It's a good investment for them. They get publicity out of it, and no one buys them. They harvest the jewels and recycle them. $12.5 million for a bra. Somebody sees that in the catalog and says, I'm a prudent shopper. I bought the $350 undergarment ensemble for my wife. That's where the money's going. Nobody's trying to harm anybody. Everybody's rational. Everybody wants nice things. What's nice, though, depends on context. And so that's where the system sets up that expenditure pattern. And here's where tax expenditures can come to the rescue for this. It's a one-stroke change that would create, I claim, a couple of $1 trillion a year of new resources out of thin air. So I call it the progressive consumption tax just to emphasize the logic of it, but a better marketing name, I realized, for it would be the name that Sam Nunn and Pete Domenici used when they proposed this tax in 1995 in the Senate, the unlimited savings allowance tax. Focus on the tax expenditure side of the issue. And so here's how it works. You report your income to the IRS the same way you do now, and because of the identity, consumption plus savings equals income, if we can figure out what your savings are, then we can figure out what your consumption was this year. And people already document their savings for 401k accounts. We know how to do that. We'd have to beef that up, but we can do that. and then a standard deduction, let's say $30,000 for a family of 4, subtract that off, and it just works very simply. So here's the Jones family, annual income $50,000, they save $5,000, the standard deduction $30,000, so their taxable consumption would be $15,000. The tax rate starts off low, 20%. Annual tax bill about the same as it would be under the current tax system, but then the tax rate rises, and it rises, and it rises. And there's no logical reason to be concerned that it's gone too high at the highest consumption levels, because unlike the income tax, we're not taxing savings any longer. We're taxing only consumption, and consumption beyond a certain point. Let's talk about consumption beyond $5 million a year if you want to focus on that. How urgent is it? Milton Friedman sent me a paper after I published an article about this tax in 1997 saying he didn't think the government needed more revenue, so he disagreed with me on that. But if it did need more revenue, I think right now we're in the situation where, I don't know if you would agree that it does, but many people think it does, then the hands-down winner for generating more revenue would be the progressive consumption tax. And he enclosed an article that he wrote and published in 1943 in the American Economic Review advocating the progressive expenditure tax. So, we've got some bipartisan wisdom here. Look at how it affects the spending decision. Here's a family. It's trying to decide whether to build the big addition onto its mansion. It's already got a pretty big mansion, but incomes have been growing. We just got a tax cut, they say. Actually, we got a loan from the Chinese, but it was called a tax cut. What shall we do? Shall we build the bigger wing on the mansion? Well, here's how the incentives play out. They're spending $5 million a year already, so they're in the top marginal tax bracket on every extra dollar of consumption. I'm going to assume, just for illustration's sake, that's 100%. And so if they build the big edition, the $2 million edition, they're going to have to pay $4 million to do that. If they scale back by half, they'll only have to pay $2 million, the same as the cost of the original bigger edition. And the government gets $1 million more in tax. They can put $2 million more away in savings. Everybody wins, because if people respond in parallel to that incentive, and it's a pretty powerful incentive, then the mansions don't grow as fast, and they're just as satisfying as they would have been if they'd grown faster. Because the only effect when they all grow more is to set the bar higher that defines how big a mansion people like that need. That's the logic of the proposal. Okay, we can go lots of different ways. Carbon taxes have been proposed. Same idea: tax harmful activity. Congestion taxes and gas taxes. The carbon tax doesn't obviate the need for a gasoline tax. There's all these other externalities caused by gasoline consumption. And it's very easy for people to adapt to these kinds of extra penalties. So if you're driving a 15-mile per gallon vehicle now, you can switch to one that gets twice that mileage and carries the same amount of cargo as before. The Europeans pay more than $2 a gallon more than we do, and they seem happy with their choices that they've made to adapt. They spend actually less on fuel each year than we do per capita. So focus taxes on harmful activities, focus tax expenditures on activities that generate positive externalities. If you do both those things, you make the pie bigger. Making the pie bigger is the starting point for any sensible policy change. This is a once-in-a-century opportunity to change the way we conduct public policy in the country. The months are going to go by. If we don't make the kinds of intelligent changes that are just sitting there on the table, there's trillions of dollars of cash on the table. It's a chance to sort of take that money that's now being put to uses that don't accomplish much and do some real good with it. So I think I wrote about this for the first time in 1985. The book came out in January. I was thinking, well, by spring there'll be a bill going through the Senate and we'll be dealing with all this. That didn't happen. Probably won't happen this time, but I'm plugging away, trying to get the simple point across that we should be efficient. So thanks for inviting me again, and hope I didn't take up too much of the time on the program. Yeah, let me free this up. So he's ready. Yep.
Thanks, Bob. That was, I think, a great opening to what we hope will be a very provocative series of conversations. We've asked, as part of the program today, we've asked Eric Toder to put together an analysis, data-driven analysis of the distributional effects of tax expenditures. And again, I think it will help set the context for what should be a very lively discussion following. Eric Toder is a senior fellow at the Urban Institute and their Tax Policy Center. He's held a number of high-level positions within the U.S. government, including Deputy Assistant Secretary at Treasury for Tax Analysis and Director of the Office of Research at IRS. Interestingly, he's also been an advisor to the government of New Zealand in their innovative tax reforms, and he's held professorships at Tufts University and the University of Michigan. So please help us welcome Eric Toder.
Well, thank you for the kind introduction, and thanks to the New America Foundation for inviting me here. I'm not sure I should thank them for putting me after Bob Frank. After that position, after that fine speech, I might not turn up so well. So what I was doing when Bob was speaking, I was thinking of 5 ways my presentation would be different than his. First, it's kind of obvious I'm going to be boring and technical, not dramatic, but please listen anyway. Second, I can't pretend not to know about taxes. If I don't know about taxes, there's something the matter with me. So no. Third, I don't have a proposal. I'm just going to talk about data and how to interpret it. Fourth, although I'm an economist and I worry a lot about efficiency, I'm not going to talk about efficiency at all. I'm only going to talk about distribution because that's what I was asked to do. And finally, kind of in the reverse of things, I'm going to start with some fairly dramatic numbers that I'm going to put up on the screen, and then I'm going to spend the rest of my time telling you why you might not want to believe those numbers. So I hope I will leave you a little bit confused as opposed to, hopefully enlightened. All right, so the first set is how big tax expenditures are. This is from a paper I co-authored with Len Berman and Christopher Geisler, and they're 2007 numbers. We did 2 simulations, one assuming the AMT wasn't patched, and 2 assuming the AMT was eliminated. Since it was patched, the correct numbers are probably somewhere in between those 2. And as you can see, the size of tax expenditures are quite large, about $750 billion. Those are only tax expenditures in the individual income tax, and they exclude those that relate to the measurement of business income. So anything that's on your Schedule C or on your partnership return is not included. It does include provisions that relate to saving or capital gains. That is in there. That's about 45% of the sum of revenue plus tax expenditures. That is, if you say our real tax burden includes the tax expenditures and then what you give back is a form of government spending, then it's about 45% of that goes to tax expenditures. Another way of looking at it is about almost 80% of individual tax revenues. And those pictures could be read either way. Okay, so now I'll get to the distributional effects. And this is eliminating all tax expenditures, and this is looking at what that does, all the individual tax expenditures that were in the previous picture. And this is what it does to after tax income. And as you can see, the results are fairly dramatic. Although all groups in the distribution benefit from tax expenditures, the largest are for the top quintile, and within that, the largest is at the top 1% of the income distribution. So judging from that, you could say tax expenditures are large and tax expenditures are regressive. So I guess what's wrong with that picture? Well, to get you a little confused here, I'll show you another picture. And this is saying, supposing that tax expenditures were all eliminated and we cut marginal tax rates across the board. So instead of the rates going from 10% to 35%, rather. That was the numbers we used. They went from 5.6% to 19.6%. So it's about a 44% across the board. That would be approximately revenue neutral. And you see from this that the benefits of this, the winners from this change are the top 1% of the distribution. The losers are people at the bottom because they don't get any benefit from the marginal tax rate cut, and they lose their earned income credit, child credit, and so forth. So it's a very different picture. The bottom line, which I will pursue from this a little further, is what you say about the distribution of tax expenditures depends on what you assume would be done with that revenue if the tax expenditures are eliminated. And you can't make a blanket statement about the distribution. Okay, so before I get to the next one, I'll go back so you don't get confused looking at housing. I want to talk about some of the issues in measuring distribution. A first issue is what's the baseline? I mean, what's a tax expenditure in the first place? Stanley Surrey, who developed this concept, had an idea of a normal income tax, which was a broad-based income tax. Some of the people in the economics profession, including Bob Frank, from his previous talk, doesn't think that's the kind of income tax we should have. He thinks we should have a progressive consumption tax. Well, if we had that kind of tax, some of the things that are big tax expenditures, like the preferences for retirement saving, would fall off the board. They wouldn't be tax expenditures. They would be the normal way those items are treated. So others would stay. So and other big ones would stay. So it really depends on what you're measuring these against. And so you have to keep in mind that's what these calculations are. It's a theoretical comparison of what we raise relative to what we might raise with some alternative tax system. There's a problem because these are cash flow estimates. They measure the revenue loss in a particular year. Usually that's okay, but for something like saving, it's not. Because what the example is with IRAs. Again, if you have a deductible IRA in that year, it's going to show up as a big revenue loss. If you have a Roth IRA where you don't take a deduction, but you exempt your future income and withdrawals, it's not going to have a revenue loss of substantial magnitude in the year it's put in place. And so those numbers are going to look very different, even though the amount of incentive for the saver may even be greater in the case of the Roth IRA. So cash flow creates some problems for some of these measurements. Behavioral responses. We assume there's no behavior involved in this. Since I'll be talking about mortgage interest, I'll use that as an example. If we were to eliminate the mortgage interest deduction, I can guarantee you that a lot of high-income people, and I would be one of them, would pay down their mortgages. Why keep a mortgage and keep some tax-generating assets if you're going to now, not everyone can do that. Younger people, particularly, would need to borrow for their house, so they would end up paying more taxes. But other people would be able to do financial readjustments that would reduce some of their tax burden. Incidence of tax is a boring subject. Who pays the tax? Who actually bears the burden? We always assume when we look at individual income taxes and the government agencies that do this, that individual income tax payments are borne by the individuals who pay the taxes. Quite a reasonable assumption, usually. However, when you look at things like the charitable deduction, for example, that might be questionable. We're basically saying the benefit of the charitable deduction all goes to the individuals who give money to charities. Charities, however, think it raises the money they get. And of course, if charity gets more money, charities get money, somebody who the charities are supplying services to benefit. We don't know. That's not in our estimates. A more subtle issue, which is I will raise, it's difficult to explain, has to do with how are wages determined in the marketplace. And this has to do really with the estimates for both healthcare and saving, which I will talk about. The assumption that we make is that fringe benefits replace wages. So dollar for dollar, if I get an employer contributes $5,000 to my 401k as a matching grant, that's substituting for $5,000 of wages that I would have been paid. Now, as a general proposition, the notion that workers pay for fringe benefits in the form of lower, as a group, is a pretty sound economic proposition. But the notion that that works worker by worker is very questionable. In particular, low-income workers get very little benefit from 401ks, and so there's not much ability for employers to lower their wages in order to induce them to come work for them because you're getting a 401k. So for high-income workers who do get a lot of benefit, they're probably willing, they could be willing to take a lower wage or a lower total compensation because the form of their compensation is more valuable to them. So that, if that's true, if that's the way markets work and not the way we assume they work, then the benefits of 401k don't look as tilted to high-income workers as they seem to be, because high-income workers are somehow, the wage structure is changing as a result of the existence of these plans and the anti-discrimination rules. The same thing is true for health care, for health care benefits. Employers, low-income workers at big companies get health care benefits. We assume they're losing dollar for dollar in terms of the premium that's paid, but that may not be the case. Okay, so finally, the last question, the last issue before I present the data, I think I've just, there we go, is what is, all of these numbers, all these assumptions depend on how you pay for this. Clear example was the Tax Reform Act of 1986. A lot of tax expenditures that benefited very high-income people were eliminated. That was very at the top. But they also reduced marginal tax rates, the biggest for high-income people. So it's not necessarily the case that you would have some neutral reduction. Congress, if it eliminates these tax expenditures, may try to keep the distribution the same. We don't know what they're going to do, but they can do whatever they want with the rates. Okay, so the first thing I'm going to talk about is owner-occupied housing. I'll just present a few pictures. You can see owner-occupied housing is the distribution mostly goes to the high-income people, although the top 1% get a smaller rise in after-tax income than the average. The reason this benefit is tilted this way is because, first of all, it doesn't benefit non-itemizers. They don't get any benefit from these deductions, and that's most people, and most people in the bottom brackets. Most people in the top brackets are itemizers. And the second reason, of course, is that the value of the deduction for mortgage and property taxes rises as your marginal tax rate goes up. So those are two reasons it's tilted. The reason it doesn't continue to rise for the top 1% is a result of the fact that after a point, your expenditures on housing don't rise in proportion to your income. Okay, so now let's look at what happens with various offsets. And the bottom line here is, and we looked at three revenue-neutral ways of giving back the money from eliminating these deductions. And it turns out if you cut the marginal tax rates, those are a little harder to see, but the net result is that the top 1% and the higher income people, oddly enough, the top 1% benefit and people at the lower middle benefit. The people who lose from this trade-off are people in the upper middle part of the distribution who have the biggest benefit from the mortgage deduction. However, if you were to give out a flat rate refundable credit, that's kind of our way of simulating maybe spending programs that equally benefit everybody, then it looks very regressive. Then if you substituted the tax expenditure for a flat rate credit, the huge biggest benefit would go to people at the bottom of the distribution. It'd be the same story for the other ones. Let's go to health. The only difference between health and housing is that health is not quite as progressive as housing. Even when we don't make the adjustment that I talked about for incidents, even when we use the traditional way of looking at incidents. And the reason for that is, first of all, you benefit, since it's an exemption, it benefits non-itemizers as well as itemizers. The second reason is that basically health expenditures, at the lower end, as you move up the distribution, coverage rates rise, and so more people are getting these employer benefits. But as you get higher up to the point where most people are already covered, the amount of premium that you get as your income rises goes up very little. So the benefits don't rise much with income, and so actually the benefits begin to drop even before the very, very highest part of the income distribution. So while this looks generally regressive, it's not nearly as regressive a tax expenditure as is sometimes believed. And again, we have kind of the same picture when you give back the revenue. But here's a case where giving back the revenue unambiguously benefits people at the top of the income distribution if you give it back through marginal tax rate cuts. But again, when you give it back through this flat demogram, it's always going to benefit people at the bottom, relatively. Okay, finally, saving. I don't have quite as much pictures for saving. Saving is a much more complicated issue. And how much time do I have? 5 at least. Oh, wow. All right, so let me go a little slow on saving then. This is complicated because let me just first say what this includes. We're including as tax expenditures all of the special savings accounts that you can put into for retirement. So it includes employer contributions to defined benefit and defined contribution plans. It includes employee contributions to 401ks and other employer-sponsored defined contribution plans. It includes IRAs. It includes plans for the self-employed. So that's all in there. And the way the tax expenditure is conventionally calculated consists of 3 pieces. One, the assumption is that the way this would otherwise be taxed is you would pay a tax on your earnings when you earn it. You would pay a tax on the income from your investments, and you would pay whatever tax you would otherwise pay. So that tax that you would otherwise pay includes the benefits of capital gains preferences or anything else you would get outside of a retirement account. And then when you get the money paid back to you, since it's money that's already been taxed, you would not be taxed again. So the tax expenditure following that has 3 pieces. There's the revenue loss for the deduction of the contribution. There's the revenue loss for not taxing the buildup within the account. And there's an offsetting revenue gain from the taxation of distributed pension income. So these figures are basically netting those 3 pieces. Now, again, as I said, these are representing, you could think of this as the revenue loss relative to a situation in which these preferences were always not in effect, so that if these had never been enacted, revenues would have been different. If we were to eliminate these tax preferences or change them in some way, what we would typically do would be to change what you could contribute, what your new contributions could be. We would still tax money coming out of pensions, and we would still exempt the income buildup on contributions previously made. So if you did something to cut out the new contributions, the effect would be very different than this. And what you would have to look at, and what the Tax Policy Center does when it analyzes this kind of proposal, is it looks at the present value of tax saving on your contributions this year, looking forward. And that's quite a different calculation. I'm not saying the distributional effects would be all that different. I just don't have that figure now. So that's the story for retirement saving. Again, you can see it goes up quite dramatically through the bottom top quintiles, but the reason it's, again, is less as a proportional income for the very rich is because these contributions are capped. So at some point, your contributions don't rise as your income goes up. So finally, the last chart just shows the revenue breakdown of this tax expenditure. Our preliminary calculation is an annual loss of $170 billion, and it consists of 3 pieces. The bars to the left are which is most of that, is the exemption of of income accruing within accounts. The other two pieces, which almost offset each other, not quite, is the left one is the loss on the contributions, and the right one is the pickup on the payback. And those could differ for two reasons. One, people could be in higher tax brackets at the time they're contributing to the accounts than they are in retirement when they're getting the payments. And also it reflects the timing of the buildup of these accounts and the size of old accounts relative to new accounts. So the bottom line is, yes, if you look at the overall picture, tax expenditures are regressive, but it really depends on what you would do with the money, and there's a lot of issues in kind of how we measure the burden of taxes that are debatable. And so some of these things, and finally, of course, you got to look provision by provision. They're not all the same. So thank you very much.
Thank you, Eric. If we could have the panelists come up. We've got a, careful here with the cord. I probably want to go around. We've got quite a distinguished group and a large group for this type of presentation. So, careful with the cord. Of course, yeah. Teresa reminds me, and appropriately so, that while it was on the opening slide, I hadn't specifically mentioned that we're sponsoring this event in coordination with the Schwartz Center for Economic Policy Analysis at the New School for Social Research, as well as the Committee for a Responsible Federal Budget and Maya McGinnis's Fiscal Policy Program here at New America. So I'm glad you did remind me of that, and I hope you all will take advantage of the excellent material that both the Schwartz Center and the Committee for Responsible Federal Budget produces regularly. So as I said, we have quite a panel and a large panel. We've asked, just to set this up, we've grouped our panelists around the issue area, the specific tax expenditure that they'll address, and we've grouped them very broadly as pro and con, which was not meant to box them in any way. I think everyone here probably has some idea on tweaks or reforms, or in some cases dramatic reforms of the existing tax expenditures. So pro and con is probably not a full enough description of their positions. But in the interest of a little Jerry Springer tension, we've decided to put folks in a pro and con category. And so we've got them grouped in the order of healthcare to my furthest right, and I'll introduce our panelists, housing to the middle, and closest to me we have the folks who will discuss the retirement savings expenditures. So let me give some quick introductions. We've asked each of the panelists to give a very brief opening statement on their position and on the issue, and then we'll move to a moderated panel discussion. So furthest to my right, we have Roy Rampton. Roy is a visiting fellow at the Council for Affordable Health Insurance. He's also a former senior health policy advisor to President George Bush. He was also very involved in the Treasury Department's implementation of healthcare tax credit programs, and in the course of all that has earned the nickname of Mr. HSA for his support of health savings accounts. So, and I believe he'll be addressing some portion of his remarks to that issue. Next to Roy is Doug Holtz-Eakin. He was most recently the Director of Domestic and Economic Policy for the McCain 2008 campaign. He's had and continues to have distinguished service with a number of institutions and think tanks, including the Peterson Institute and the Council for Foreign Relations. He was also, most importantly probably for this discussion, the Director of the Congressional Budget Office, and prior to that, Chief Economist for the Council of Economic Advisors for President Bush. Next to Doug is Paul Bishop. Paul is the Managing Director of Real Estate Research at the National Association of Realtors. Prior to joining NAR, he was a senior financial economist in the Division of Insurance at FDIC. Next to Paul, we have Danilo Pelletiere. Danilo is the Research Director of the National Low Income Housing Coalition. He has also served in various posts at George Mason University, and is a past Fulbright Scholar in the field of economic development in Germany. Next to Danilo, we have David Ray. David is the president of the Profit Sharing 401k Council of America, and they represent companies that provide over 6 million individuals with 401ks and investment vehicles. He is frequently a frequent testifier before Congress and a recognized expert on this issue, and we appreciate his being here. And then finally, one of our partners in producing today's event, who's been a wonderful help and inspiration, we have Teresa Ghilarducci. She is the Bernard and Irene Schwartz Professor in Economic Policy Analysis at the New School for Social Research, and as I said, the director of the Schwartz Center for Economic Policy Analysis. She's written a number of books that relate to the topics she'll be discussing, including When I'm 64, The Plot Against Pensions, and The Plan to Save Them, which is a nice, provocative Beatles-themed book, which I'm sure, again, she'll address some of the issues she raises there. So with this distinguished panel and this much brain power, we figured we needed someone who would be up to the task, someone as moderator, someone who has tackled a multi-trillion-dollar budget in his previous life. And so we asked Jim Nussle. Jim is the former chair of the House Budget Committee. He's also the, as I mentioned, former director of the Office of Management and Budget for George W. Bush, and is steeped in all of these issues as well. I think importantly, in the political considerations that go along with any sort of reform to tax policy. So, Jim, if we could have you come up, or actually, why don't you stay down while they're giving their presentations, then if you could come up and moderate from there, we'd appreciate it. So with that, I will hand off to Roy Rampton.
Good morning. Well, there's no doubt that the tax exclusion provided for employer-sponsored health insurance has had a very positive effect on insurance coverage in this country, with 85% of Americans having some form of insurance coverage, most of us of working age getting our insurance through our employer. This has been one of the positive aspects of a tax expenditure, as we have seen in some of the other areas. Also probably has contributed to our overall health as a nation. People with insurance coverage tend to have better access to care, get more care, and we also like to believe at least that we are leaders around the world in the quality of our healthcare facilities, the training of our medical providers, development of new technology and pharmaceuticals, all of which contribute to our overall life expectancy and health. Sometimes we tend to struggle against some of the other behavioral issues that relate to our health as well, but at least when we're sick, this is the place that we want to live to get our health care. At the same time, the tax policy has had a profound effect on behavior, and unfortunately, in most health policy discussions, I find the discussions of tax policy and the relationship to behavior in terms of consumption, et cetera, profoundly lacking. And we have seen that the tax policy has ended up creating a bias towards insurance consumption versus out-of-pocket consumption. And not only insurance coverage purchase, but also employer-based purchase of insurance. On top of that, most employers offer some kind of a flexible spending account that allows people then to further take advantage of tax benefits for their out-of-pocket expending. And so it should be no surprise that over the last 50 years, we're now at an all-time low of spending of roughly 15% of the healthcare spending being out of pocket as opposed to covered by insurance. As has been brought up before, these subsidies generally favor those in higher income brackets, and there's a copy of an analysis done by the Lewin Group out on the out on the table, so please pick that up. But all of these phenomena, in my view, have encouraged the overconsumption of insurance, and because of the insurance coverage, also then encouraged the overconsumption of health care relative to savings. Health savings accounts and other forms of consumer-driven care, I believe, are an attempt to tilt that balance back towards the middle by reducing the bias that is inherent in the current tax policy between expenditures in the form of insurance versus the expenditures in the form of out-of-pocket direct purchase of health care. And whether or not you are a fan of HSAs, it cannot be disputed that people spend their own money differently than they spend somebody else's money. And insurance is usually that other people's money that they're spending. Most people would probably not buy the same insurance that they get through their employer today if they were purchasing that insurance with their own money. And because of the insurance aspects of health care, we also find this a significant lack of transparency to the actual consumer in terms of the cost and the quality of the care, although that is starting to change in my opinion. What I would propose is that we look at making sure that these tax biases are neutralized, and so that an individual does not have a greater incentive to purchase health care in the form of insurance relative to out-of-pocket, but that when they have equal incentives, that they have an opportunity to economize and save the money that is not purchased and let that accumulate for future health care purchases, being it during periods of unemployment or in retirement. I'm sure there's probably some agreement between Doug and I about actually dealing with the exclusion and whether or not to cap it or whether to replace some of the current forms of tax expenditures with other forms such as credits. But we need to apply that to all forms of healthcare consumption, not just focus on insurance. Look at insurance and out-of-pocket spending all as one package. So with that, I will turn it over to Doug Holtz-Aiken.
Thank you to the many co-sponsors of this event for the chance to come. I am now much too old and beaten to know if I'm for or against anything, but this is a good time to think about the exclusion from tax for the employer-sponsored insurance because of the importance of health care reform and what we're seeing now with the administration and the Congress taking up this issue. So let me just walk through some of the dimensions of the issues that will arise in any such debate. And you know, you start with the simple ones, which is from a tax policy perspective, regardless of whether you're a consumption tax person, as I am, or an income tax person, as some are, this is a tax expenditure. There's no question it belongs in the base of either of these things, and you can't get around that. It's also not one that was deliberately constructed. This reflects a policy error of the most fundamental sort, price controls in World War II, leading to the desire to provide compensation in the form of untaxed fringes. It's never been defended, as the mortgage piece has, as central to those things which are American. I'm skeptical of that, and we have put a piece out that Bob Carroll and I wrote. I've never found the notion that somehow you have to live in a house to be a good American, and that it sort of is a good way to counter revolution. The Swiss don't live in their own homes, and they seem pretty peaceful. So, but no one ever makes that argument here. I mean, this was a mistake, and it's a big mistake. This is a very large tax expenditure at this point, but the size issue is one that you have to tread delicately on. And so remember that you can have a very large health insurance policy for three reasons. Number one, you could buy a gold-plated package with all the bells and whistles that you may or may not buy if you're paying out of pocket, or you could have it because you happen to live in a part of the country which, due to these inexplicable geographic differences in healthcare costs, is just really expensive. And if we repeal the exclusion, we're going to tax people based on their geography in ways that they might not feel are appropriate. You could also have a very expensive policy because you're sick, and so if we repeal it, we're going to tax people based on their health. And the flip side of that is we're subsidizing sick people, and we're subsidizing some geographic locations, and that's a reality that will enter into this debate and has to be understood. It's going to interact with some of our other policy objectives. It's well known that there's been a lot of study of whether this subsidy of employer-sponsored insurance leads to, quote, job lock, people being unwilling to change jobs because of fear of losing their health insurance, something that I've looked at in my academic career. When was it? New Year's Eve 1990, I had a major operation, a right renal auto transplant. It's a very, very cool thing. And I woke up out of the surgery, and I was reading the New York Times. It says 50% of Americans won't change jobs out of fear of losing their health insurance. I thought, I'm going to teach at Syracuse University forever. I mean, they got to understand this. But this is an issue. It interacts with that. It interacts with our regulatory objectives by pushing people in the employer-sponsored market. Our individual markets are thinner than they might otherwise be, and we struggle to use other tools to fix them. And if you repeal this, you have to pay attention to the payroll tax consequences as well, or if you put it into the payroll tax base, we've done Social Security reform simultaneously. You have to decide whether you like the tax subsidy or essentially a tax plus spending policy as a more effective way to get people insured. And that's just a fundamental policy issue. On the campaign, the McCain campaign proposal was essentially repeal the exclusion and replace it with a voucher. So it's a tax plus a refundable credit approach, which we felt would be more effective in getting people insured and would be fairer as well, because it would reduce inequities across the income distribution and between sources of health insurance. The flip side is if you do that, you're raising the marginal tax rates on labor supply and things like that. And so there are no freebies here. You might reduce the distortion in the composition of in the composition of people's pay between tax and non-tax fringes. You might make things fair in some sense, but you will also raise effective marginal tax rates. And then the reality is you have to decide, is this a tax policy? In which case it's a tax expenditure. You repeal it and you figure out, as Eric did, what your basic budgetary offsets might be. Or is it health policy? And if it's health policy, what is the objective? Is it employer-sponsored insurance? Is it insurance? Or is it private insurance? And that leads to very different configurations for what you do if you get rid of the exclusion. And so the bottom line is we are going to have this debate on a political dimension. I mean, we've already seen some of it. I will go to my grave with the images of the ball of yarn in my head unraveling the employer-sponsored market. And that, I think, is a vivid testament to how hard it is to take on any one of these in isolation, and probably is the biggest argument for fundamental tax reform, where we deal with multiple tax expenditures and other issues in the tax code simultaneously, so that you can clean the thing up on a broad scale and not let targeted opposition to removal of these expenditures arise. I'll stop there.
Good morning. In terms of talking about the real estate side, I guess I'm in the position of the pro versus con in terms of the mortgage interest deduction. And it's clear from a social policy standpoint that there is an emphasis through the tax code, and there's no doubt about it, in terms of home ownership. And just to give you one number, in fact, right now the home ownership rate is at 67.5%, and that's down somewhat from what it was at its peak a couple of years ago. But one of the arguments for providing incentive for home ownership and doing that through the tax code is presumably there's other externalities, other benefits other than those that just accrue to the person who purchased a home. And there's been documentation of this. The research has shown, for example, that homeowners are more involved politically and more involved in their communities. They have a longer-term perspective in terms of the value of investment in their community. There are benefits to children versus homeowner or versus parents who live in rental housing. There's more social interaction. There's more neighborhood upkeep, more investment in the home than there is in the case of renters. So the perception and belief is that those are the externalities that we like to see, and the research has documented this more or less, that those in fact are true. A couple of the questions that arise from that, though, is does the mortgage interest deduction and the tax favored status of that encourage home ownership? And I would say probably to some extent. We, of course, survey home buyers and sellers on a regular basis and ask them a number of questions about the process of buying a home and what are the reasons they chose to purchase a home and the characteristics of the home they purchased and so on. And, it is interesting to look at what are the reasons people choose to buy a home. And the mortgage interest deduction, even if it is for generally those home buyers in the higher income bracket, those benefits of that flow out through the entire housing market. One thing to keep in mind about the housing market, it's a different market than many other markets. My ability to buy or sell a home depends on someone else's ability to buy or sell a home. So to the extent that there are incentives for someone to trade up, that means that other potential buyers in the housing market are also going to have some benefit to the extent that now they're able to get into the housing market in an easier, more direct way maybe than they could have if there's a less dynamic housing market out there. But I think one of the other issues that maybe I have a little bigger concern about in terms of some of the discussion here is about whether or not the mortgage interest deduction and the tax advantages associated with that lead people to buy bigger homes. Again, based on the survey research we've done, the reasons that people buy a home have to do with proximity to their job, quality of the neighborhood, and things of that nature. And when we ask what are the first things that you had to compromise on when you purchased a home, it's price and size of home. So there's more factors in the decision to buy a home than simply, the availability of the mortgage interest deduction, and I think the impact of that on the potential to buy a bigger or more expensive home sometimes can get overemphasized. I don't want to say that it's zero, but for the vast majority of people who aren't buying a $5 million home, it's probably less of a concern, less of a point in their decision making than, again, how far is it from my job? Is it the quality of the neighborhood that I'm looking for, and those types of decisions? And so I'm less convinced by the argument that it has a direct impact on the size of homes that people buy, and as we saw earlier, some of the negative ramifications of that in terms of potentially overinvesting in housing. I'm less persuaded by that line of argument. So I'll be happy to follow up on any of these things, but rather than take more time, I'll leave it at that and turn it over to the con side of this argument, I guess.
Good morning. I think that the National Low Income Housing Coalition has been critical of the mortgage deduction since it sort of emerged as a standalone exception in the tax code in 1986. And sort of it is this case where it's not a deliberate construction. It sort of emerged in sort of taking away other deductions for interest, and sort of that was the politically most had the most staying power, and so it stayed in the tax code. And so what we're left with essentially is a costly social policy that's a subsidy. It's an entitlement. In other words, if you qualify, you get the money no matter what sort of is out there in terms of the budget. And it does have demonstrably little effect on sort of the overall homeownership rate in this country. And so, from that perspective, when you're talking about sort of a costly subsidy that's an entitlement, generally in Washington, that's good reason to debate, its reform, Social Security, whatever else. This one doesn't get quite as much debate, and we'd like to see that change. One obvious reason why we're interested in it is because we spend a lot of time working on behalf of low-income people, and they're sort of tarred with this subsidized housing, their housing situations being subsidized. We've added up, we've sort of done a little bit more than what you saw today. We've added up sort of all the expenditures, outlays, and tax expenditures on housing. We did this in 2006, and there were about $150 billion worth of outlays on housing in the government, in the budget, tax and outlay side. And $94 billion of those went to the top quintile. So in other words, half of all our expenditures on housing go to that top quintile. About $25 billion went to the lowest income quintile. And so in a situation where we have a large number of people who are spending over 30% of their income on housing, who are living in substandard housing, that are homeless, that seems fundamentally wrong. And so, especially given that there's general consensus that as a policy, it wasn't even designed necessarily to do what it's being asked to do, and it does it fairly poorly and fairly expensively. The question is, why do we still have it? And obviously one reason for that is because there's a home builder and a realtor in every congressional district in the country. And I think that obviously you've been doing business with this policy in place, and you're probably fairly loath to give it up. As Mr. Holtz-Eakin was saying, obviously in many countries they've got similarly high home ownership rates without a interest deduction. and many countries do fine without that. But also, they've got home builders and realtors that do fairly well without the mortgage interest deduction. And so I think that, particularly in this current environment where people do recognize that a policy, that the one thing there's sort of consensus on is it does sort of encourage, and I'd say there is consensus, more investment in housing than there would otherwise be, and more leveraged investment in housing, and that the current crisis is, in fact, a problem of sort of overinvestment and over-leverage in housing. And it's a contributing factor, certainly not the sole factor in the problem in the United States. And at the same time, before, where people, rightly with a $200,000 home might have thought that next year the house was going to be worth $1 million, that feeling is no longer with us in the general electorate. And so it's a time to begin to talk about redesigning, reworking with this policy so that we can make it less expensive, more equitable, more efficient. And clearly it's very simple things, like a tax credit for low-income home ownership, so that people who don't itemize get a benefit and actually may make the choice to become homeowners because of it. And obviously, for the National Low Income Housing Coalition, we would like to see that go lower and see savings from redesign of the mortgage deduction really assist in helping extremely low-income renters provide housing for them so we don't have homelessness, so we don't have these problems. But again, I think there's a lot of room for reasonable debate. It's very interesting, though, that we haven't been able to have any debate about it, and that's obviously something I think that in the current environment, the National Low Income Housing Coalition would like to see, is more debate about how we get the incentives right so that it's efficient, equitable, and effective. Thank you.
Thank you for inviting me. It's a pleasure to be here. First thing, I want to draw a distinction between retirement plan savings and the other programs described. I think they were touched on. These are deferrals almost universally. There will be tax paid on these eventually. So what you're really doing is sort of loaning the value of the tax benefit to participants, and then they sort of pay it back when they pay their taxes later. So this is a little different kind of program. And remember, we don't know what the tax rates are when this money comes out. Who knows what those tax rates will be and what the government will need at that time. So the government itself is actually sort of investing in the future by deferring some collection of tax today so they can collect it tomorrow. So the deferral of the retirement system tax is very different. Okay, so with that, and by the way, there's a copy of this paper back there. I don't know how many we had, but this sort of talks about that a little bit. First thing to say about the retirement system is that it works. Even with the downturn in the market, we probably have over $13 trillion set aside in the system. This is more money in total, more money per capita than any country in the world has outside of a government program. And $1 trillion is real money. $5,200,000 houses is what $1 trillion will buy. So it's real money. In Illinois, guy and I'm from Illinois, instead of $1 billion here, $1 billion there, pretty soon you have real money. Well, I think that works for trillions, even more. Second thing is that the retirement savings we have in this country is absolutely facilitated by the employers. If you look at the underlying accumulation and all the different vehicles under there, you see almost all of it is facilitated by an employer decision. What we know is that when employers decide retirement benefit accumulation happens, people do not save for retirement. They don't set up programs on their own outside of this system. So we need employers if we're going to have these kind of programs. Employers do plans because they want to give their employees the benefit of the tax deferral. People who pay taxes would like to pay less taxes. And so the employers know that by providing a program where people get the value of the tax deferral, this is a benefit to them. They like that. And so this encourages them to have programs. So the fact that we have the tax incentive we have actually incentivizes employers to go through the aggravation of setting up and managing these programs. And believe me, for those of you who don't know, it is aggravating to set up and manage one of these programs. They're distracting. Companies make cell phones, and governments, help people register their cars. So, when you look at that. It is an employee benefit. So understand that it is an employee benefit, which means that regardless of where you work, if you are paying tax in some way, you get the benefit. So it's not the organization gets the benefit. So in the retirement system in the United States, if you work for a for-profit company, if you work for a not-for-profit company, if you work for the state of Illinois, the benefit flows to you as the person, not to some organization. So the benefit of this accumulation is really quite egalitarian in that way. We're not selecting out the organization a person works for. It really has benefit to all the various folks. People who the other thing is that there have been efforts to change the law to make it more valuable, I would say, to the second quintile. There's something called the Saver's Credit that has been brought into play to balance that. I think that we're going to see that made more robust by making it refundable. I think that you're going to see a substantial improvement in that the second quintile that was described earlier. Even those who pay no tax benefit from this program because these programs are required to be broad-based. Lots and lots of folks who pay no taxes at all, no income tax currently, benefit from these programs. Depends on how the programs are structured, but I can tell you in 401k plans, 20% of the people who are eligible who pay no income tax participate in the programs. And I think the value. There's other values. There are matching contributions, other things bring these people in beyond the fact that there's a tax benefit. And finally, I would say that the system in the United States really is a coordinated system. The private or the voluntary retirement system that I'm describing here is a complementary program to Social Security. Social Security is quite progressive in its benefits. It is really questionable that we can efficiently accumulate significant retirement benefits for people in the bottom quintile based on any kind of earned relationship. They don't make very much money. It's very, very hard for people who can barely have enough money to buy shoes for their kids to set aside significant amounts for retirement. So we have this complementary program. People in the bottom quintile benefit substantially from Social Security as a balance. And clearly, to the extent I think that we would need to help that group more, I think that we have a great program. It's called Social Security, and maybe we need to make the progressivity of Social Security more, steeper, because it's very difficult to figure out how you're going to help people who are in and out of the workforce and who make very low income accumulate the kinds of benefits we have. And both defined contribution and defined benefit plans, and that's what we have, both of those really, it's difficult to reach that group. So the group, I think the system works very well for the top 80% of the workforce. Clearly it helps people who pay taxes because it incentivizes them to save. It has worked. We have accumulated an enormous amount of money. And of course, when the market turns around, it'll be even more. So thank you very much.
The last time that David and I were paired was on a Fox News program because I testified in Congress in October that the $80 billion and rising that's going to 401k contributions should be rethought for its efficiency and its equity, the same kinds of principles that Professor Frank talked about. That we should be treating our tax expenditures just like we treat all of our other spending, with the same kind, direct spending, with the same kind of scrutiny and the same kind of questioning about whether or not it meets social policy. On that Fox News program, David and I were opposed, so it's quite clear who's pro and who's con. We were focusing on the 401k system. I will claim that the system where we actually tried to supplement Social Security through this indirect subsidy does not work at all. We are facing a generation of retirees, these are baby boomers and beyond, who will do worse than their parents and grandparents in terms of their retirement income security. Not only are the projections for our replacement rates when we go into retirement and therefore are falling, therefore poverty rates will be going up, especially for women and other low-income groups. Will be going up. We are also facing not only just average replacement rates falling, but we're also facing much more insecure sources of retirement income. Over the past 30 years, because of the 401k plan, which is the 401k is a change in the tax code, the 401 section of the tax code, Section K, which was implemented in the late 70s as a way for executives to shelter their income from tax. David Ray cleverly helped expand that to cover a broader group, and it has led to, over the 30 years, to a failed experiment where this little portion of the tax code that was meant for executives have replaced the employer portion, the employer pension portion for most workers, has replaced the defined benefit system. So now we have the tax exemption for the defined benefit system, which, if you look at Eric's proposal, is much more progressive, with this more regressive portion, the 401k section. It has led to not one iota of more coverage in the supplemental part. 30 years ago, we had half the workforce covered by employer pensions, and guess what? Today, we have half the workforce covered by employer pensions. But it's changed from a defined benefit or insurance portion to a financialized system. So now we have just the same amount of people not covered as we did before. We're facing the tax expenditures for 401ks rising by 49% in the next 5 years, that for defined benefit plans falling by 9% in the next 5 years. We have now facing, with this depression, tens of millions of people who have much less in their retirement accounts than they did before, which means a permanent loss in welfare, which will probably mean a much more difficult time in actually boosting consumer sentiment. So it's probably making the recession much worse because consumer spending will be affected by this loss of wealth. It also means that workers who otherwise would have retired on their defined benefit plan and their Social Security are actually back into the labor pool in the worst labor market in 26 years. We are also seeing that when retirees switch from an insurance or defined benefit source of income to a financialized source of income like the 401k, that they lose a sense of well-being, meaning that retirees are actually much better off with an equal amount of money in insurance or a secure pension than they are with equal amounts in a defined benefit. And when older workers' well-being falls because they fear losing more and more income, they cut their meds and their meals. So in six months, I predict, we're actually going to see a deterioration in health and nutrition among the elderly because of the growth in the 401k plans that have occurred because of this tax expenditure. So the system does not work in many ways that we can measure it. It's also has led to a growth in inequality in retirement wealth. We saw the numbers from Eric, complicated as they are and as nuanced as they are, is that this tax benefit, the way it's constructed, goes much more to the top 20%. The numbers are, if you figured it out, about 70% of the tax expenditure goes to the top 20%. And it seems as though it hasn't grown retirement savings at all because many of those folks have moved their retirement savings from taxed accounts to non-taxed accounts. We would be much better off if you looked at Eric's graphs in actually taking that tax expenditures and giving a tax credit to everybody. So I, as well as two other academics, Jonathan Foreman at University of Oklahoma, Alicia Manel at Boston College, and myself, working independently over the past three years, have proposed a mandatory savings supplement to Social Security, which would be partially funded by a tax credit to everybody. So right now, if you're in a household with $200,000 of income per year, you get about a $7,000 tax break for your retirement savings. And if you're making $20,000, you get zero. We have proposed that everyone gets $600. It's revenue neutral, and yet you're giving actually retirement wealth to half the population that doesn't have it now. This proposal I have is called a guaranteed retirement account. There are various versions of this, but it would require that all workers save 5% of their income to a pre-funded account. That account would be converted to an annuity at the time of retirement, so we know that there's low leakages into other forms of spending. This actually helps women more than men because the 401k system has a particularly deleterious effect on women's retirement income security because when women have access to funds, they tend to take it out for their adult children and for other reasons. So the combination of being a mother and having a 401k is actually very bad for retirement accumulation. So we can either actually get women not to be mothers, or we can get women to have defined benefit plans. I think social policy would say we would need to actually increase our fertility rates. So in sum, and I would want to close here, I claim that the 401k tax deduction doesn't meet any of our qualifications for good social policy. One, it's inefficient. It actually does not add to the retirement savings of the population that needs it the most, and it's ineffective. It hasn't led to any increase in savings because we see the people who are getting the most benefit have just shifted from taxed accounts to non-taxed accounts. Thanks. Do you want to stand here? No, you just...
We, first of all, thank you. Great presentations. Let's give them a hand for their participation today. We've had an opportunity today to hear from, as you can tell, the tables are stacked in three different areas of conversation, but they all do interplay. Obviously, healthcare policy interplays with retirement policy, and most people's retirement is steeped in their home, and so they're all interconnected, even though there are three separate tables with distinct differences of opinion. A number of you mentioned comprehensive tax reform as a possible or potential or necessary process in order to deal with the particular issue that you brought up. Let's fly to that 30,000-foot area for just a moment and answer the question, is that the best? Should we deal with your subject areas or other subject areas in a more comprehensive way as opposed to picking them off issue by issue? And the reason I say this, and I think particularly in healthcare, we're about to go into a huge debate over healthcare. Of course, taxes will be on the table as the Finance and Ways and Means Committee will be managing much of this process. So should we be looking at this as in a more comprehensive 30,000-foot vantage point, or should we continue to pick these off one by one? Since Doug, you brought this up first, I think why don't I put you on the spot? Put you on the spot first. Since you brought it up first, let me turn to you and get your opinion. Should we? Can we? And if so, what kinds of things should we be thinking about as we venture into that minefield?
So should we do comprehensive tax reform? Yes. Unambiguously, the U.S. revenue system badly broken. And I think that's indisputable. Can we? Analytically, yes. There's no question that the President's Commission of a few years ago put together revenue-neutral alternatives that were much simpler, some of which came close to the sort of consumption tax base that I would prefer, and which really are models for where you could start in producing a better tax code. Can we politically? Obviously, that's the key question. It's been done before. 1986 was, in fact, a crowning achievement where we put in place in almost 3 decades later the academics' ideal of the tax code from the 1950s. Unfortunately, it was not suited for the 1990s, and it unraveled really quickly. So we need to, I think, do a consumption tax reform because it would be more stable in this economic environment. I think the politics of it are ripe given the enormously daunting fiscal outlook for the United States, where the CBO's projections of the president's budget are enough to make anyone ill if they think hard about them. So this may be the right climate to do it. Now, I'm now going to contradict myself because that's what I do. If you take all of the reforms and do in tax reform, it might actually hinder the health reform debate. I mean, there's a big chunk of people thinking about healthcare reform who view the exclusion as, quote, the financing mechanism. If you take that off the table, it might stop the healthcare reform. So they interact politically as well, and it is something that I worry about.
Would you agree with that, Roy? You'd agree with that too? Do you want to comment on whether health policy or health reform in the context of comprehensive tax reform is the right way to proceed, or how would you approach it?
Well, it depends on, again, whether people are looking at this from a tax policy perspective or a health policy perspective. And a lot of people who do health policy but not tax policy see billions of dollars here to use to refinance, healthcare in this country. And there are only a couple other big pots of money like that, and one of them is Medicare. And we've been tinkering with Medicare for 40-some years, and nobody's really happy about how that happens. Providers keep getting cut every year. We get more people on the program, and people are actually talking about expanding that program rather than contracting it. So, like I said earlier, I don't find very many people who understand how the tax policy affects the health policy, and we've got to be very smart and thinking about what are those behavioral effects that we want out of our health policy and construct the tax policy accordingly.
I'm going to come out and give our audience a chance to ask some questions too. But Danilo, what would you say vis-a-vis housing policy in this country? There's obviously been a few attempts in the course of history of taking on the mortgage deduction as an example. Is comprehensive tax reform the place that you would look to take this on, or is this more of a rifle shot approach that that can maybe finally score a target?
I think that. Obviously, I think whatever gets the job done, in a sense. The approach of the Obama administration of sort of tackling deductions as a whole doesn't seem to have done any better than sort of the mortgage interest deduction. We'll see. We're going to hopefully engage more of that debate. I think that it goes back to something's got to be done. Clearly, the tax policy is overly complex, and for the folks that we're concerned about, it does very little. The earned income tax credit being an obvious advantage or example of something that could perhaps be expanded on and used to greater effect. So I think that it's a debate we want to have, and we're more than willing to have it move as a total package or in isolation. But it's time that we sort of address that, and particularly again the inequity of it, and then the effectiveness in terms of getting people into decent housing.
Paul, how would you approach? Obviously, you don't want to see this in either a rifle shot form or comprehensive tax reform.
It goes down to a question of be careful what you wish for, in the sense that to the extent there are limitations on the mortgage interest deductibility, what are the ramifications for the rest of the housing market, given that people have purchased a home with some assurance that policy is going to be in place for at least the length of time that they own their home. For example, limiting the mortgage interest deduction at the top end, for example, it's very possible that when you limit the value of a deduction to, say, even those at the highest income levels, then that's going to make home ownership potentially a little less desirable or a little more costly, depending on how you want to look at it. And if you make home ownership a little bit more costly, it's not hard to imagine that may have some implications for home values, even if it's only at the top end. Many times that would cascade through other parts of the housing market, especially in those areas that are high-cost areas already, the East Coast, the West Coast, for example. So while we don't know exactly what the dynamics would look like at this point when you have home values down in most areas of the country and home ownership and home equity being a significant portion of most people's wealth, whether now is the right time or not to do it, I would say, better be cautious about what the unintended consequences might be, either as a rifle shot approach or as more comprehensive.
David and Teresa, what would you say about the need either for comprehensive tax reform or as a way to tackle some of the retirement issues that you brought up today?
Want me to say it and you can.
Yeah, why don't we go you first?
Yeah, you can have the last word. I'm absolutely in favor of the rifle shot because I think that limiting the 401k deduction to just $5,000 per year would actually mean that most everybody would keep their 401k. They like it. They like to gamble. Let the government help them, invest in the market. But limiting that deduction would give us enough money to give everybody. I mean, that's half of the workforce. It doesn't have anything now. Give them $400 for a retirement accumulation. That accumulation should be managed by a not-for-profit agency, probably looking like what the federal employees have. So rifle shot, limit that 401k deduction, take the money that we save, spread it to everybody else's who doesn't have a retirement income accumulation, and let's just solve this one problem we have now.
David?
The retirement area is different, and because first off, for example, even our presentation, we skipped Social Security and the tax. The fact is, one of the largest tax revenue base in the United States is Social Security taxes. It's a huge piece of the system, and you have to look at that. I think that we are, and even Teresa, I think, is acknowledging that the future is really about defined contribution plan accumulation. She has her solution. We have a different solution. We have to have, if we're going to have 30 years of retirement after, you have to fund that with a substantial base of delayed personal consumption. There has to be savings on an individual basis. It has to be there. On the other hand, that system will not work for certain people in the system. People in the bottom 20% of the tax bracket, people who make very little money, they're in and out of the workforce, that system doesn't work. There must be a substantial government safety net, which is Social Security, and for which we pay a large tax now. So the issue here is you have to be very, very cautious. We have a system in place that even though the percentages are not growing as fast as we want, the number of people coming into the system is growing rapidly. We're still adding millions of new participants into the defined contribution system every single year. The amount of money they are saving both collectively and on an average basis goes up every single year. Even last year when it was a bad market, over $300 billion was saved in these plans. The average amount saved increased from the year before. So the system is working for a community of people. And so we want to be very, very cautious about disrupting that as we think about all these other issues. It gets tangled up in a lot of politics. I do think it's good that we have come to a conclusion that I think that there has to be a fundamental government base that takes care of the people at the bottom of the income scale, and that there has to be defined contribution arrangements for the rest of the folks. What we need to do is figure out how to get there most effectively. I'm certainly willing to engage in that debate. We're very committed to making that happen. We think the employers are instrumental in making that happen. We don't agree that people would do this on their own, and certainly middle-income people, who are by and large, almost all the 401k people are middle-income people. They would be doing this on their own without their employer. So we need to be very, very cautious about tipping over something that is really gaining real momentum, I think, in the workplace.
We could go on for hours on all of these subjects. We only have about 15 minutes left. Let's turn to the audience, see if anyone has any questions for our panelists. Anybody have any? Yes. Please state your name, where you're from, and
Carl Davis with the Institute on Taxation and Economic Policy. I think we've heard a lot of really good discussion here about the effectiveness of these programs and debates over the behavioral and economic responses from these. I'm curious, though, if anybody on the panel, more specifically the people in support of these programs, are worried by the lack of political review of these and the lack of oversight of these in the policy process, meaning that these don't come up for review and reappropriation, and that we don't even consider the cost of these aside from in an appendix in the president's budget. And more specifically, I'm curious if there would be anyone on the panel opposed to incorporating these into a performance review system, similar to what we already do with the program assessment rating tool, with programs that are actually a lot smaller than the hundreds of billions of dollars we have going out the door through these things.
want to tackle that, Doug?
I think that's a good idea. I mean, I guess I'm a little less convinced than you might be that we're doing an effective job of scrutiny on the spending side. So let me just stipulate that at the outset. But there's no reason to exempt these entirely from the basic question of cost-benefit analysis, which is, are we getting what we want out of these programs? And to leave them literally unreviewed is to avoid the most basic public policy question of all.
I would just say I think the retirement system is getting plenty of review. We have, I could say that virtually every year since 1978, if we want to go back to 1978, we've had some legislation affecting the retirement system. It is constantly under review. It is discussed over and over and over again, and we're adjusting it and tweaking it. So, I mean, actually, it might be better for the retirement system if everybody just stopped for 2 or 3 years. We didn't make any changes. We got everything in place so that we have finally caught up with all the regulatory compliance that's necessary, and then did a really substantial overview evaluation. That might be very useful. I think what we're suffering from is way too much oversight, on an ongoing basis. I'd like to stop that for a while, get everything. Employers who are running these plans are constantly distracted because there's some new regulation flowing out from Washington. So give us a chance to get everything settled, and then let's have a really comprehensive review. I think that could be very valuable.
So, can I respond to that? I mean, I think that there are two different things that shouldn't be confused. One is oversight of participants' compliance with the stated rules and regulations, things like that. That's fine. There is a lot of that. There's a very different thing which happens if you put it into something like the part, which is someone has to write down the presumed objectives of this policy. And writing something down crystallizes thinking in a very concrete way, and it then creates, I think the technical term is a firestorm of debate on Capitol Hill about whether those are really the objectives. I think that'd be a good idea.
Danilo?
I just like to add that, again, from a sort of research perspective, as much as we may disagree with the government numbers, it's extremely important to have that sort of government review, government sort of research that says, this is the objective and this is what we think is going on. And that can really help rationalize the debate in a way that sort of ad hoc, year-to-year discussions never, ever do.
All right, let's jump in here.
Yes. Hey, yes, my name is Alistair McFarlane, and I'm from HUD, and I have a question about the issue of tax incidents, and this is something that I haven't heard discussed, and maybe it's because it's a boring issue, as Dr. Toder said, but I think it is applicable, especially to residential real estate, where the benefits of any tax expenditure should be capitalized into the price of that asset. And I was wondering to what extent the panelists had an opinion on that. For example, my thinking would be that the implications could be that consumers would pay more for housing as a result of the mortgage tax deduction. And I don't know if Professor Holt-Seekin or Dr. Pelletieri have evidence of that.
Anybody want to respond?
Boy, last thing I want to do is walk through the dispute over the incidence of this. But I mean, there's a simple way to think about what's going on here, which is that this is indisputably a subsidy to capital invested in one sector of the economy. And we know, broadly speaking, that subsidy leaks out of that sector and will more generally be a subsidy to capital in the economy. And that's the sort of basic incidence insight that comes out of looking at any sort of tax or subsidy to capital used in individual sectors. And so that's who's going to benefit. It's going to be the sort of capital owners in the economy. And the question is, whether you A, like that from a distributional point of view, and B, whether it's worth the efficiency cost of giving an incentive to park more of the nation's capital into residential real estate.
Housing table want to respond?
Well, I guess the question boils down to what are the benefits, and are those benefits greater than the cost? And I would suggest that while we have looked at and documented some of the benefits, I mentioned a few of them, I'm not sure that we have as comprehensive a view of what the benefits beyond the economic might be in terms of home ownership and the benefits beyond just the return to the homeowner himself from the policies that's in place in terms of mortgage interest. So if we can get a broader view of what the benefits are, and I would suggest that it would come out probably looking even as a stronger case than it has in the past based on the research that we have so far.
I'm not enough of a tax guy to even know what debate I'm wading into exactly. But I do think.
But you're going to go ahead anyway.
Yeah, absolutely. I do think that it is an undeniable subsidy, and we're saying that we would like folks to invest in this form of capital, and perhaps not in other areas. And so I think that it does affect prices, and it affects the sector, and I think that's something we need to look at. And that's part of the problem, is that we really don't have a lot. I was reviewing a lot of the research this week, and a lot of these questions aren't sort of nailed down. I mean, it seems pretty obvious from the theory, but we certainly should look at it.
Name, where you're from, question.
Martin Vaughn with Dow Jones Newswires. I wanted to ask Doug and Roy to go back to this question of changes to the health insurance exclusion to finance healthcare overhaul. And as you pointed out, I mean, Congress looks at that as a large chunk of money. They don't want to just start taxing everyone's health benefits willy-nilly. So they talk about either capping the exclusion or possibly an income threshold, such that the burden of taxing benefits would fall more heavily on higher income people. I wonder if you could talk about the desirability, the relative desirability of those two approaches, either a value cap on the exclusion or an income threshold.
Go first.
Yeah, doesn't the cap eliminate the tax expenditure as theoretically? No?
No, it just caps it. Why don't you go first?
So I think the easy one is that the income-related threshold does not make any sense to me. The sort of notion that you want to, in this sort of under-the-radar way, increase marginal tax rates on people just seems completely wrong-headed from a tax policy point of view, and it doesn't accomplish anything from a health policy point of view. So. And as I point out, there are many different reasons why you might be over that quote cap, and some of them have really fundamental implications for health policy. You could be in a high cost region, you could be sick, and so that's not an income phenomenon. And I think that's just the wrong way to go on that front. The cap is one alternative. I mean, what the cap does is it takes away the marginal subsidy above the cap, but it's still a subsidy. You've got it there. It appears more politically palatable to some people. You can write down credits that are equivalent to caps and not have them be refundable. So there are lots of ways that you can reconfigure the basic subsidy and take it away at the margin. These appear to be the two are on the table at the moment.
I'd only point out that we deal with this in healthcare all the time, where we try to take something away and replace it somewhere else, and it's constantly playing with a balloon. You push in somewhere and it pops out someplace else, and we never seem to anticipate what all of those unintended consequences are. As I mentioned earlier, have to keep in mind that not all health care consumption needs to be in the form of insurance, and so we need to understand what's insurance, what's out of pocket. Is that a good thing? Is it a bad thing? Who does it impact? What does their consumption do to their productivity as workers? And all these other things that health seem to factor into our economy. So it's not a simple question. I think there's going to be a lot of differences of opinion in terms of what is the best approach here, but we've got to start.
It's Mike Udell with Ernst & Young. I would just like to offer up that I think there is a common theme going across all of these tax expenditures, at least the three we're talking about today, and it's a theme about asset adequacy. Whether you're talking about the 85 or 15% ratio of insurance subsidized or out of pocket, or you're talking about the inadequacy of 401k plans losing 50%, or in fact the subsidy for housing. Most people have all three or combinations of all three. And in fact, what we hear when we hear in the press is when you only have one of them and that one goes down, that's when we hear the noise. So now because everyone's 401ks have gone down, we hear that from the newscasters. Yeah, so the question is, thanks. Are these really all three very much linked together by households being able to have a basic amount of asset adequacy?
Absolutely, and that would have been a great way to frame this. We picked these three because they're big, these tax exemptions. We actually didn't talk about capital gains. But it is clearly the way the United States actually provides social policy in these three crucial areas. We didn't talk much about the international comparisons. It was alluded to, but the United States really stands apart for using the tax code to implement social policy. That's why I think Bob Frank recognizes that when he prepared for this talk. And so it really goes back, I know we're at the end, but one of the inspirations for this event was good government. So the question we got from the floor was, shouldn't these tax expenditures, which are supposed to meet social policy just like our direct spending is supposed to, have the same kind of scrutiny that our direct expenditures have? And the implied answer is yes. We should scrutinize it for their efficiency and their fairness. This is what the Bipartisan Commission on Entitlement Reform was aimed at, where the entitlements that Senator Kerry and Senator Danforth dealt with in the mid-'90s were Social Security and Medicare. We know about those entitlements. But the third one was these tax expenditures. They're an entitlement too. And they clearly in the past 10, 12 years have not gotten the same kind of scrutiny. So we hope today would actually start that conversation in a public way. This is probably the first time I've ever seen a kind of a debate format. It's very complicated, as we saw, but I think this should be a beginning of public forums like this to actually do the good government thing and actually scrutinize these the same way as we would scrutinize the defense budget or Social Security.
Anybody else, Doug? You want to go?
I don't think that's right. I mean, as a matter of analytics, the retirement problem and the health problem have a similar insurance and risk component. You might need to have adequate resources to self-insure against health costs or the prospect of living too long and running out of money. And those are clear insurance issues where self-insurance and the incentives that come with self-insurance have a role in thinking about the policy. I don't see that in housing. I don't see anything like that. What we have instead is a social policy which, from many dimensions, not just the tax code, says we like Americans to live in owner-occupied homes. And that's a very different issue.
Anybody else want to know?
I think that while they might be different, obviously I think for a majority of Americans, to the degree they own assets, it's a home. And to the degree to which they've got a retirement plan, it's a home. And so I think that we've done that to housing. We've made housing, we've financialized it, well, no, absolutely not. We don't have to. And that is part of the, so it's not really, and that's part of the distribution of the mortgage deduction is that for that middle group of people who do get the deduction, don't get very much perhaps, but those are the folks who have so much of their retirement tied up in their home. And so I think that is a real problem, that we've sort of made the home into that, and that's what makes reform so difficult. Because if you're a middle-income person and 90% of your wealth is in your home, you get anywhere near that home, whether it's reform of the mortgage interest deduction or putting multifamily housing next door, you freak out. And so that's what's going on, and it's a real barrier to reform that we should just deal with housing differently than we do currently.
I just want to add, I think that housing is an important part of this. Even though it's different, in some ways it's the same. When you're looking at retirement, you're looking at total assets. And a person who rented all their life is in a very different place at retirement than a person who paid off their home over 30 years and has $400,000 in equity that they can convert into income to pay for various things. So the integrated, and frankly, 401k participants probably shouldn't be in real estate in their funds. They should own a home as their real estate component of a total investment strategy. 401k is not the single place for people to have enough money to retire from. It's a combination of things, which is why, from a retirement perspective, I can see, I went back and forth, but I think they are somewhat together, because we're talking about, I like that we're trying to figure out what's the adequate assets that people have from all their components. And these are big. Not only are these components big tax expenditures, these are big expenditures for individuals. I mean, if you look at what people spend their money on, they spend their money on health care and homes, and when they retire, they need the retirement income. So I think that the idea of combining these actually works quite well, though I have to admit I was a little skeptical originally.
We're stepping on the final moments. We're going to have one final question here.
I just, Bob Helmsley, I just want to make a quick historical point that there is a historical precedent for the tax cap. When the War Labor Board in World War II made the decision to exclude fringe benefits, they said they had to be reasonable. They couldn't be over $5,000 a year. What happened after the war was when the board went away, so did that cap, and the tax exclusion for health care and pensions and so on then became open-ended.
All right, good place to end. Frank, I'll turn it back to you.
Thank you, Jim. That was some very able moderating. We'd love to have you back in that capacity. Yes. It's well, thank you very much. I want to again thank our partners in putting this event together, the Schwartz Center. Honestly, I do, and Teresa was a guiding force in how we framed and how we executed this. So I want to particularly thank her, and the Committee for Responsible Federal Budget, and all of our panelists. Thank you very much, and thank you for attending.
Thank you.